The Education Lounge podcast.
Well, I don't know if you've been in the market for the past couple of months.
I have. It's been very, very red.
Basically a sea of red.
Sea of red.
So today we want to talk about investing a little bit.
Mm-hmm.
Why do you think it's important to invest?
Well, it's current sacrifice for future, for your future gains.
Yeah. So, because we work in the education industry, and I kind of see it in the same vein. So, when a parent or anyone really decides to take up education, then in a sense they're looking for some kind of future payoff. So they're kind of sacrificing time or money.
Well, both really.
Yeah, in order to produce a better future.
Yeah. Well, I mean, the idea is that what you're going to get back later on is worth more than that money at the moment. And so, like things like the S&P 500 and that, they've outperformed. Well, they outperform banks in terms of that what interest they give you.
Yeah.
So your money's basically worth more, or it makes more money. Your money makes more money when you invest into things like that, as opposed to keep saving it, and then it doesn't really grow. I
mean, everyone's noticed prices going up. So inflation over time there's the hidden tax, isn't it?
Yeah.
So like if they don't raise taxes, then they're looking to steal from the future. So the government's looking to steal from the future in some way, and that is through inflation over a long period of time, because it gets easier to pay off that debt because you've got rising GDP. So they basically look better to the public or the electorate because they can promise tax cuts or that kind of thing, or not raise taxes. And the only way we can sort of pay for all our public amenities like the NHS, school system and so on is by inflating if you inflate the prices of everything, then revenues increase.
Yeah.
And
yeah. So when did you and why did you start investing? And what did you start with?
Actually, it was kind of school that started me down the path.
Really?
Because although, we'll get into this, there's a lot wrong, I think, with how things are taught in school.
Well, yeah, and what's not taught.
But I remember in a maths lesson, learning about compound interest. And I think most people just learn it in a very, they don't really think about how it applies to them. So they don't really think about how an idea applies to them. But then I started thinking, when I was 14, 15, that it's quite a powerful idea, really. And I remember I'd be plugging numbers into my calculator. So I'd be imagine if you've got £10,000 or whatever, and you compound it at a rate of, say, 5% over 50 years. And then I realised how much you can make just with that initial investment.
Yeah, I mean, I have to say when I did compound interest at school, it wasn't a thought that crossed my mind at that age. It was more like, okay, I need to learn this.
I was not a normal child. So, like, yeah.
Yeah, I don't think many people would have thought about how to implement it. It was more like you need to learn this and like know how it works.
And then I think also like your parents play a huge role in sort of setting you on your journey, because although my parents, and especially my mum, they're not big investors. I think my grandfather was though, and my grandmother was, but I didn't really have a chance to learn much from them. They would save. And sort of the start of investing is saving, because you need to, in order to save, you need excess cash.
Yeah.
And that's a very important principle that people usually forget, is it's not just about the rates of return that you get on an investment. It's how much are you actually contributing. Because if you contribute regularly to something over a long period of time, then you've got a chance of making gains. And that's one thing that especially my mum got correct. She's a big saver, doesn't spend that much. And she'd also sort of bank account churn. So she used to swap to get the higher rate of interest, like every few years or something like that, and lock in gains. And yeah, so I guess I started learning about investing from a relatively young age in that sense, but not properly investing in the stock market. Only thinking about interest rates and rates of return. Yeah,
I mean, at that age, I was saving was okay. I could save, but yeah, I didn't know. I've only actually started doing trading and investing and stuff in the last 2 years. So it's something I wish I started like 15 years ago.
No, yeah. If you've been because when one of the best times to have invested would have been when we went off to university, because it was 2008, 2009, and that's the financial crisis. Well,
I mean, the only reason I went into investing at the moment is because everything crashed, obviously, in March 2020. I didn't know what I was doing. I opened up a free account, and I was like, well, the airlines aren't running. I looked at the charts for like quite a while, a few weeks, and then I thought, all right, I just put in £10 just to see what would happen, and then gradually, now I'm at a point where I'm putting in
a regular
amount every month, and I've chosen a load of stocks that pay dividends, and I've had it set to automatically reinvest. So obviously, what I put in compounds. What's already there compounds. You get gain from the stocks hopefully going up, which most of mine have, and then you get your dividends that get put back in automatically. So to increase the compound effect.
A very important part of investing is the vehicle that you're investing into as well, because an important part of investing is avoiding as much tax as you can on your investments and your gains. So setting up an ISA.
That's what I've done mine in.
Yeah, so stocks and shares ISA. There's also lifetime ISA, which is so the government tops you up
25%.
Yeah, it's 25%. Yeah. So, and the max that you can put in it is 4,000
a year.
Yeah, 4,000 a year. Between April and new tax year.
Yeah.
So that's a really important part of investing, is actually reducing. Because if you think about it this way, if you had your dividends in a taxable account, then
you get charged on the gains that you make.
If you need, I mean, your dividend allowance per year is about two grand, I think. So
yeah, I mean, I'm nowhere near that yet, but
so essentially, you've got to, if you've got a lot in investments, then it can really hurt you if you don't And also, if you get taxed on capital gains, so that's when your equities or stocks or instruments of like financial instruments gain value. And basically, if you sell them, then it's counted as a capital gain. So you've also got to sort of bear that in mind. But in a non-tax account like an ISA, it won't matter. Do you think there was do you think there's anything that we should have been taught in school that we weren't?
Quite a bit. Nobody really teaches you about money.
Yeah.
How it works. What to do, what not to do. Oh, there's quite a good Explained on Netflix by VOX. They do all of the illustrations and stuff. It's like a multi-part series that teaches you about, like, well, you saw some of it, didn't you? Credit cards, like loans, mortgages, how it all works, taxes. I think all that sort of stuff should be taught in schools, but it isn't, because obviously who makes the curriculum? there's some stuff that you need to learn on your own.
There is that, but I suppose the thing is if everyone does it, then remember, this is a capitalist system. So essentially, you sort of benefit from the fact that people are ignorant of
this is my point.
Stuff.
This is my point. There's a reason why it's not in the curriculum. But it's also. I mean, I'm not too bad with savings and that sort of stuff. I've never, like, I wouldn't go into debt and that sort of thing when I didn't need to. Build up a credit score, all that sort of stuff. But I do think it's something we should have learned, or I should have learned earlier.
Yeah, one of the most important things that I think becomes clear to me when you talk to people is people don't know much about pensions at all.
Yeah, right. Neither did I until.
If you think about it, that's the most important reason to invest. Is at some point in your life, you probably first of all won't want to work anymore, or will be unable to work anymore. So your ability to earn income on a monthly basis just decreases rapidly.
Yeah, well, there's a graph, isn't there, where if your age is along the bottom and your ability to earn is along the y-axis, it kind of does that. It peaks and then it tapers off. Yeah.
So, of course.
Yeah.
So you want your investments to be compounding over time and doing this. And if you don't even understand how pensions work, then, because some people think it's just like magic. It's like a magic trick. So the company somehow puts it, so you get workplace pension, right? Like the company just puts money aside and then returns it to you later. But if you actually read into it and understand investing, you'll realize that they actually invest in a portfolio of assets. And you can't always trust the company to invest in, or you can't trust your company necessarily to invest in things that will deliver the most return. Sometimes they'll play it way too safe, or sometimes if you're a little older, it's important to actually be less risky in terms of how you make investments. If you've got a long period of time, so if you've got a worker in their 20s, then it's more rational to take as much risk as possible in, I'm not saying make bad investments, I'm saying invest in mainly equities, or stocks, rather than something like bonds, which over long periods of time will be outperformed by stocks.
Yeah.
Whereas like later on in your investment life, so when you're like 50s and 60s, you might want to take a bit less risk and not have such a great exposure to equities, and have more bonds and things like that in your portfolio, just to offset that risk in case of market downturns. Because what happens with a pension is that your assets are drawn down. So if there's a financial crash or something like that, if you're at a low point in the market, then essentially your pension will be drawing on a low pot. So it'll be eroding the amount that you've invested like very quickly if they draw down upon that amount. But if you had mainly bonds in your portfolio, then chances are it will fall less, a lot less than stocks, because stocks are ownership in a company, but then bondholders get paid first. So the real difference between bonds and stocks. So bonds are they're basically debt. So you're buying debt and getting interest, and they're paid first. So people who own bonds are paid first. Then you have the preferred shareholders, and they're paid, and then you have your common stockholders, and they're paid last. So if a company goes into liquidation, then the bondholders will be paid first. Usually the stockholders will be left with very little. So yeah, that's kind of important to know. Because some companies will either take too much risk and invest in something like mortgage-backed securities when their clients are old, which is not necessarily, I mean, we saw during the financial crisis, it wasn't the best place to be, like when you've got a housing crash or something like that. Or they invest too much in certain companies that have, they might have revenue growth or something like that, but they don't have meaningful cash flow to survive in a recession or something like that. So that's quite important. Or they've got excess liabilities or loans, debt. So it's really important that people are aware of what's in their pensions. So who's managing it? What are the fees on the funds or the stocks, or trusts, investment trusts, or whatever's in it? Okay, they should be aware of what's in it. And really, a company should, and this is kind of why I like to manage my own financial affairs. I'm not suggesting that you should if you don't know what you're doing, but I like to know what I'm investing in over a long period of time, because it will just determine my gains and losses.
So we spoke briefly about what was taught in school and what wasn't taught in school. What are your thoughts on that? Like, I've kind of said roughly what I think.
Yeah.
Firstly, what do you think should be added? What should be taught in schools? And secondly, what do you think is taught in schools to help you with this sort of stuff?
So if you don't study business or economics, but I do think you miss out on, first of all, learning about the system that we're living in. And I think that's quite important, to know the system that you're living in.
Yeah. Yeah.
And
as
actually
as early as possible.
Yeah. So first of all, I guess it's a bit different in my case, because I would say it's also the responsibility of, it's also important for the individual to take on some responsibility themselves. It's it's not just the job of the state education system.
Yeah, well, and parents as well. I think parents should already be relatively educated on this sort of stuff. You'd be surprised some people aren't, but a lot of it is their job as well.
But then, having said that, I think most parents aren't that astute when it comes. Well, if you take the average parent in the United Kingdom or the average person, they don't save nearly enough. They don't invest nearly enough. They don't have enough in their pension. I doubt they understand. I mean, they might have learnt it at one point, but I don't think they understand the principle of compound growth. So I don't think there's really... and we've got a system that essentially is aimed towards getting people to spend. Right? And if everyone saves and nobody spends, then the system sort of collapses.
Yeah.
So there's very strong incentives for people not to be educated in this way, even though it might be the most important thing that they ever learn.
Yeah, I think it probably would be.
Like, I know it's kind of changed my life and how I approach things. Sort of thinking about everything towards the long term. Investing, not spending too much.
It's basically the marshmallow experiment played out over your life.
Yeah.
Right.
But I remember, like, it's true. If you've got, I've had this experience a few times when you've got quite a large amount of money in a bank account or something like that, and then your immediate reaction might be to spend it, like, because that's kind of what society is forcing you to do.
So there's two tips I would give on that. The first is get a separate bank account for your savings, obviously.
Yeah.
So that to you that money doesn't exist.
Yeah.
And the second thing, which is really, really important to do, automate it.
Yeah.
Don't, because if you have to rely on yourself to be, actually this month I'll put in like a bit less because I want to buy this. Just set up an automated direct debit, £100 a month, whatever it is, and just let it go out. But you'll be surprised how much you don't notice what's not there. Like if you take £100 a month or whatever, you'd be surprised how much that doesn't really change your day-to-day life.
It's interesting because we've got this idea of ratio. We learn it very young.
Yeah.
Year 5 and 6, sort of. And that's really one of the most important concepts that you'll ever learn, because as long as you get your ratios right throughout your life, in terms of what you're spending, what you're saving, what you're investing, and that kind of thing, you will generally do quite well. I mean, for instance, if you manage to save 25% or save and invest about 25% of what you bring in, so income-wise, then that's usually quite a safe ratio. Right? So
it's quite high.
Yeah, it is high. It's difficult.
Found recently that, because
that would put you in the top savers and investors, sort of countrywide, like easily. Because I think most people would save like a ridiculously low amount. It's like 5 or 10%. But if you get to between 15 and 25% into savings and investments, then you'll be surprised at sort of the effect it has over time. And I think it changes you in that you don't... When you start delaying gratification...
Mm-hmm.
I think, and becoming a bit more patient, not chasing like quick gains, then I think your approach to life changes a bit too. So I found it transformative. I do have aspirational goals, obviously, like aspirations for the future and that kind of thing. But then I can set realistic targets for how to get there. And
yeah, because if it's structured, you kind of know what's... Yeah. Yeah. So you think ratio, proportion, and compound interest.
Yeah, all of these
things. They're the things that are taught in school.
They
right?
are taught in school,
So,
but I suppose like very few people realise how important, and most people realise this at sort of near the end of their life. So they go, oh, maybe I should have done that, and you don't want to live a life of regret.
Yeah, I mean, I realised it in my late 20s, probably a few years ago. But so ratio, proportion, compound interest. The concepts are taught, the implementation and the changes it could have on your life, obviously they're not explained. Anything else? What about?
Well, you learn depreciation. That's also similarly important. So if you buy an asset, so a car or something like that, you know that if you buy a car new, then it depreciates extremely quickly.
There's like a massive...
Yeah.
So the second you turn the engine on, like move it 2 feet out of the forecourt, it does that.
Yeah.
Yeah. Just gradually.
Yeah. So buying a depreciating asset is usually a bad thing to do with your money. But I mean, if you get your ratios right, then and I mean, for instance, some people spend like half their income on their car payment or something like that, and that to me is ridiculous. Like, some people actually do that. Like, it just really surprises me. But I don't think any asset, nothing. It's not an asset. It's not an asset. Nothing should be that important to you that you spend basically half your income on it, especially as it depreciates generally. Yeah. There's some exceptions, but
they're very hard to find.
Yeah.
And you won't know until it happens.
Like vintage Aston Martins or something like that, or I don't know. You probably know a lot more about that.
Not so much about that sort of stuff, vintage and all that. It's difficult to tell what would appreciate. But when I get a car, I don't get it new. I buy it after that drop off. I don't spend half my money on it either.
Yeah, you want it to be drivable and I think easy to. Well, you don't want problems with it, so you need to strike that balance between affordability and practicality and that kind of thing. Yeah.
But different people are into different things. So like I like cars.
Yeah. You
like watches.
Yeah, that's true.
So,
but
it's fine for somebody to have.
Yeah, but it's still,
an interest.
It still would disgust me, like the idea of spending. Well, it's all down to ratios. Like, if you can get to the point where buying like a Rolex feels like buying a biscuit, then
where was that from again? Somebody
Dave Ramsey. So he was like saying he had a friend and he bought a Lamborghini or something like that. So they're quite expensive.
Yeah, like maybe $250,000, maybe.
Yeah. and then Dave Ramsey was like, yeah. So here's this. He's quite a hardcore Christian, I'd say. But he sort of uses those biblical principles in his financial advice, and he was just saying that to his friend, buying that Lamborghini was like the equivalent of buying a biscuit. And at that point, then it doesn't really matter because you've kind of, that person can now pretty much spend how they want to spend because they've sort of set up their financial future. And that's really the thing. It's completely fine to like spend a great deal on a holiday or experiences on a car, on a watch, but you need to sort of think about how that purchase will affect your ability to invest and that kind of thing.
I think it depends on your age. I was watching a video the other day. Is it yesterday? Anyway, Ali Abdal, YouTuber. He said if you're younger, say you're in your teens and 20s, the money that you could save, say it's like 50 quid or something, 50 quid saved at that age is less valuable than the experience that you could get 50 quid at that age. So if you're like 16,
well, save definitely, yeah.
If you're 16, right, and you're like going out with your friends, going like on a trip, cinema, whatever else, if that 50 quid is worth a lot more at that age, whereas 50 quid now or when you're 50, 60, it's nothing. So there's a balance between your where your age is and what you spend and what you save. So it's better to spend that sort of pocket money or whatever on an experience. But as you get older,
or invest it in some way.
You could do a bit of each. You could say you had 50 quid. I'd probably like put 10 quid aside and take 40 out. But as you get older, it changes from experiences to savings and that sort of stuff.
If you were to invest £1, so imagine if you invest £1 in the S&P 500 over 60 years or whatever, you'd end up with something like 86 quid. That pound, I mean, I know like that 86 quid will be worth less than it is now because of inflation, but it still shows you sort of the power of compound interest.
There was an interesting thing about how different ages invest. So people that were born in, I think it's like the 60s or 70s, they're used to the S&P 500 not doing much. Like it didn't really grow.
Yeah.
But people that were born in 80s, 90s, they're used to the S&P 500 going up.
Mm-hmm.
So different ages think differently about how to invest.
Well, I've heard of people who they were in the last big financial crisis, like the 2008, 2009, where basically liquidity was completely banks were kind of unable to lend and that kind of thing. That really capitalism basically was in dire straits at that point. Now they didn't enter the market again because they were so scared. Like once they lost all their money, they didn't. They could no longer trust even the idea of continuing to invest in it. Whereas people who either started investing in it or stayed in the market, they did really well.
Yeah, they'll have done quite well.
I think they modelled, like, they imagined some investor, like Investor X or whatever, investing at the worst points. So at the very peak of the market, over, I think it was like 250,000 that they gave Investor X or whatever. So they back tested this over the last like 30 years. So investing at the peak of every single crisis, and then, but the only thing that made him different was he didn't take any money out of the market in their model. Yeah. So he stayed in the market, and he still made like a few million.
Yeah, because overall it goes up.
Because over like a market goes up and down, up and down, up and down over a period of time, but the trend
upward trending
is upwards. Yeah.
Well, it's this idea of averaging in. Because if you're doing it every month, then you could buy one share at £10 and one share at £5. You know, it would average out. Yeah.
Over a long period of time, and this is what we. I mean, there's a great investor called John Bogle, and I think he wrote Common Stocks for Uncommon Profit. So I can't remember the exact title of the book, but basically he analysed the performance of, and you've heard of Vanguard, right?
Yeah, I've invested in
the kind of guy behind it. He discovered that if you sort of backtest index funds over long periods of time, they outperform most individual investors or people who invest in individual stocks.
Because you're trying to time the market.
Yeah. If you like, what it does is, so in an index fund, the index fund buys the broad market index, and usually weighted according to how much what percentage they make up in the market. Mm-hmm. So I think, like, for instance, at the moment it's a bit crazy because the FANG stocks, so Apple, Facebook, Meta, Google, well, Alphabet, Amazon, and I think it was Netflix, but I feel like at some point it probably will be Nvidia, and then you could argue also Tesla's kind of getting to that stage. They have such massive market caps that they're kind of like the majority of the market.
Yeah.
So it's kind of a very unusual time we live in, where very few companies make up most of the market, but
it's only going to get more like that, isn't it? Really?
You think there'll be anything to challenge those companies in terms of their dominance?
It would take quite a disruptor.
Yeah, it's
to change it.
I think nothing can disrupt like Apple.
No, I don't.
It's just so entrenched. Like, the brand power that Apple has, they're probably the greatest brand. Like Amazon, I wouldn't say it's got brand power in the same way that...
No, there's a lot of negative connotations when it comes to Amazon.
I mean,
somehow Apple seem to have avoided all of that, or a lot of it.
Well, the thing is that Amazon's a platform, but then because Apple has all of these devices and things like that, it's created a moat. So this again is something that you look for in a good investment, one that has a moat. So if you buy a company or something like that, you need to look for companies with strong moats.
Can you just explain what you mean by moat?
Well, I guess there's different kinds of moats. So a moat could be a brand. Coca-Cola is a good example. There may be competing products, but at the end of the day, when you walk into a restaurant or something like that, and you want a drink, and you want something Coke-like, you will always say Coca-Cola.
Yeah. Oh, we've only got Pepsi. Is that okay?
Yeah.
Yeah, sure. Just bring me some brown sugar water.
They'll always lead with Coke, and that's one of the reasons why it's such a powerful brand.
Well, I was watching something recently. It's been embedded into our psyche over generations, to the point where restaurants like to stock Coke because it shows them that they're trustworthy.
Yeah.
It's like if you look at a restaurant, they sell Coca-Cola, it must be at least a half decent restaurant. It's that inbuilt.
That idea of branding really is fascinating because it's like there may be no real sort of intrinsic difference between two things, so like Pepsi and Coke. Yeah. I know there are differences.
Yeah.
And most people will say that there's differences, but really they're kind of fundamentally the same. But Coke's as a brand is just so much more powerful, and it's
primary colours as well is a big thing. So red, McDonald's red and yellow, they have an effect. in your perception of the product. Yeah. So that's one kind of moat. Then you've got kind of infrastructure moats. So I guess telecoms is a good example, or rail networks. Or Tesla's supercharger network.
Yeah, something like that.
Yeah.
It's something that's built in there and no one can really do anything about it. And you can't really switch very easily. So it's this
is the Apple ecosystem,
and that's also
card, and each little thing hooks you in a bit more.
And Apple's is interesting because it's kind of there is consumer choice, but at the same time, their brand strength is so strong. Their products are really good, so I suppose that's a really positive moat to have. and then to a regulator as well, to like the government and things like that. I know, you know, they do kind of lock you in with a few things like charges and stuff like that, and the EU is really sort of in on them because...
I don't know if I agree with government stepping in on how a business does things.
Something.
As much as I would really, really need USB-C on an iPhone, I don't know if I agree with government stepping in and telling you how to run your business.
It depends. I think it depends on... Well...
I mean, they're more powerful than most countries, Apple, so like they're at that sort of level. But I still don't think...
I mean, I kind of agree with you, to be honest. But then I do think like there is a point for governments to step in. So if a product or service poses a great risk, and it is exploitative or something like that. But it depends where you draw the line on what's exploiting the user. Because like you could say the whole advertising industry is basically like exploitation. Exploitative.
You could argue either way.
But I mean, it's very, very difficult to make those sort of judgment calls. And that's kind of also why these big tech companies can't really be pinned down to, because it's up to values, when sort of, it's up to how you perceive the problem. So some people perceive them as like the most evil things ever, like large corporations, but then some people don't. So it's very difficult to like sort of pin them down.
I think people forget or don't realise how hard it is to get to that sort of level.
Well, yeah. Yeah.
Every one of these companies has started out in a garage or on a dining table.
Yeah. Like a cottage industry business, yeah.
Every company, even our company, started out on a dining room table. To get from there are so many different changes in how you work and people that come in and out to take even from this level to medium level to large companies to Apple, Amazon, that sort of thing. Like it's not easy.
They've solved really difficult problems. So
people forget.
I think that also boils down to education. Like I've written down here, sort of on a sheet of paper. Do you think there's a left-wing agenda in education that is kind of set against private enterprise and capitalism?
Yes, 100%.
Because I'd noticed that. I wouldn't say so much at school, but I'd noticed that at university.
Oh, universities are ridiculously left-winged. Yeah.
Like
I think at school though as well, maybe not so much left-winged, but against. What did you say? Against
capitalism.
Yeah, because you're conditioning people to wake up at this time, go in at this time, listen to the bell, have your break at this time, go back to work, go home, do a bit more work, go to bed, wake up, repeat. Like the school bells in schools are the same as factory bells.
But then
that's
wouldn't you say that supports capitalism? Like it supports the system because or do you mean
supports capitalism in terms of making your own venture and like not?
So what you say is like it sort of the system that we live in doesn't encourage individuality. It sort of
doesn't encourage individuality or entrepreneurship, anything like that.
Yeah. But then
it's built. It hasn't changed. The system hasn't changed. It's built to produce factory workers, even though we don't really have people, well, in this country really working in factories like they were in Victorian times. The school system and the way it works hasn't changed.
But don't you
We're
think
still producing that?
Don't you think though that we need, like, they do need structure in schools? Otherwise it kind of descends into chaos.
Yeah. No, obviously you need structure, but I think you should. Back to what we were talking about before, there's specific things that aren't taught in school, such as money and tax and that sort of stuff.
And mortgages.
Mortgages. savings, investing,
pensions. Although, to be honest, like with pensions, I kind of feel like maybe companies. I feel like perhaps this is where regulation sort of plays a role. Is I kind of think that companies should kind of provide a little bit of education to the employees on pensions and pension schemes, because I don't think most workers have no idea what's going on. I know in some ways there's definitely a sense in which this is kind of up to the individual. They need to sort of take control of their financial future, and sort of make effort to learn about it.
Here's another problem. Everything is going more like project based, 0 hours contracts, that sort of stuff, which doesn't require a company to do pensions.
But it's because also, the government's made it a lot more effort to like they made it a lot more prescriptive for companies to sort of
but my point is there's going to be less of that happening. There's a lot of people quitting their jobs recently as well to go and start their own thing during the whole COVID thing.
I suppose it's natural.
There's been a lot of people walk out of their jobs
when there's like disruption on a massive scale.
Best time to start.
Then people start to sort of think about life a little bit and what they want, and most people will realised at that point. I know I realised that I'm way too sort of dependent on a source of income or something like that monthly.
Yeah, me too.
And you kind of take stock of that.
Pun intended, or
no, actually not. But yeah, you take stock of that, and you realise that you do need to get a move on, as it were, in terms of.
Yeah, I've realised this. I'm beginning to start other projects outside of here to.
Because you need
increase.
To. It's like.
So yeah, before it was just what I got from tutoring and what I got from here, and now the last couple of years, obviously investing in stuff. And then I'm now starting another project to try and build up another stream of income.
Yeah. So
I mean, it will take a long time.
Yeah, anything like this does, but you learn that any sort of worthwhile investment usually takes a long time to sort of set up.
It's the same as everything, isn't it? It's consistency, persistence, just showing up each day.
It's like that value of disappointment thing. So growth in any direction.
Yeah.
It tends to never be. It's never
not
linear.
It's not like that. It's.
Yeah. And then there's this valley of disappointment that everyone sort of rests in when you go to. Well, it's happened to me too. Like you kind of think to yourself,
It's happened in everything. Think about when we started this, when we rebranded, when we started a YouTube channel, when we started Instagram, like social media for the company. There was that 2 years of just sitting in that valley, posting every single day. Yeah. Without fail. And now it's starting to see like
if you
it's the same with absolutely everything.
I think with everything in life, really persisting at something and not doing something that will fail, because some people do that. Some people think that if you keep plugging away at something, you'll naturally achieve success. But it's more if you have a plan and that goal can certainly be achieved, and you understand how to get to that goal, then if you keep persisting at it, you will get there.
Yeah.
And you won't get there in the way that you expect. So it will never be linear. It will always be exponential, which always starts off really slow, and then it accelerates at a quicker and quicker pace.
And if you do the right things along the way, You automate stuff, and you change how you work. You work smarter and not harder to get more done.
That's also helped me with investing, financially, because
it's fractal. It applies to everything.
Like any fund and things like that, you could usually set it up so invest in that fund monthly and that kind of thing.
Yeah.
And it's quite a good lesson for life. And investing is not just about building wealth and having money. It's also about your development as a person. I kind of see it more that it's like a spiritual thing for me. It kind of extends into every aspect of my life.
So what do you use HL, don't you?
Yeah, I use Hargreaves Lansdown.
Yeah, that's where my pension stuff is now.
Well, I wouldn't say it's just I've always used it, so I like predictability. I wouldn't say it's necessarily the best tool, because there are, I think there's cheaper platforms.
Because I use Trading 212, where you don't have fees per se, but what they would do is they would, if you buy a share, you'll be buying it like a fractional amount.
Yeah,
not noticeable, but a little bit more expensive than you would.
Yeah, they've got those like dividend. Well, they've got those pie things where you can.
That's a different thing. I'm saying like how it works is when you sell at a slightly lower price and then make a bit of money there. And when you purchase a share, you purchase it at slightly higher. Like it's not noticeable to the consumer, but that's how they make their money.
Yeah, it's like the spread, as it were.
Yeah, and then you have the pies where you can, which is what I've done. You can essentially create your own. What's it called? Your own
sort of portfolio of. So you select in. Sort of
so you can select
stuff like that.
So So I spent a couple of weekends looking at dividend stocks because that's what I wanted to do. Picked like 15, 20 of them, put them in this pie, and automatically invest into it every month. And then the dividends that come in, they are automatically reinvested back into the pie. So it does that.
So I've got kind of a similar strategy, but in Hargreaves Lansdown you can't buy fractional shares. But
that's the other thing. Trading 212, you can do you can buy like 0.01 of a share. Literally start with a £5, start with 10 quid.
For me, it's like,
that's how I did it.
Sounds really, really weird, but I kind of treat the fee as like, it's like you've got a few charges whenever you trade a stock on Hargreaves Lansdown. I kind of treat it as a filtering mechanism, so it kind of disciplines me, because I know that if I invest in a stock, I need to make outsized gains in that stock in order for it to be worthwhile.
For me it's like, I'll just what I've noticed, bar like one or two, is the ones that I've taken a punt on have lost me money for the most part, and the ones in the pie, the consistent
investment, because you're averaging in.
I'm averaging in. And I started it when everything was
sort of down.
Those have got me quite big gains.
So you've never experienced a massive drop in your portfolio?
I'm in the red at the moment.
No, but
quite
massive. Like you didn't.
Give me. So what do you mean by massive?
So
what sort of percentage?
A 50% drop.
No.
You've never had that.
10 to 15 at most.
See, I've gone through that. I think that makes you stronger as an investor. Like when you sort of learn about yourself a little bit and how you react to things.
Yes.
Or
I've got better at reacting to that sort of stuff. And the mindset that I have is it's not an L until you sell. It's not a loss until you sell.
What it did
don't sell at the bottom, basically.
Yeah. No, because I went through the whole like COVID crash, basically.
Yeah. That's where I started.
That was my, and I think that was my a big crash for me. But you
just put more in.
Yeah, I just went. I did sell out of a few positions because I saw better opportunities, and that's really where. I think that's an important aspect too. Is kind of realize when I realized that I was kind of too much in one sector or something like that, and then I thought, okay, wait a minute, I should really invest in this sector, because now it's at a reasonable value. So, like, for instance, Apple, like I bought that quite at its lows basically because I was like, yeah, okay, they're not really going to be that affected compared to a lot of these other things like malls and things like that, and travel.
That's why I started, because I just was keeping an eye on like EasyJet, Ryanair, and travel. Obviously dropped off. I just thought I'm just going to put £10 in here and see what happens.
I mean, but even the best investors, like so I think Warren Buffett said, and he's, I think, probably the greatest ever. Like, you could argue there are a few others that are pretty impressive. But I'd say, like, in terms of a pure investor, like true investor, Warren Buffett is probably one of the greatest. He also started really young. Yeah,
didn't we do a book review in the reading corner?
A little bit, but it wasn't. It wasn't in that much detail.
One that you did. What book was it?
Was it The Warren Buffett Way? I think
it might be.
But that was like a biography, which are quite good. You find out about his life and sort of decisions he made.
We can leave a link.
Yeah,
I'm going to leave a link to a few things.
I think we'll probably, what we'll do is we'll leave loads and loads of links to different investing books and things that I've read.
And things that are on my list to read.
Yeah, things that are on your list to read, yeah.
Intelligent Investor, wasn't it? That was one of them.
I'd say what we could do is we could do it in order of like difficulty. So, like, for instance, probably the first book that you should read, even though I don't really like the guy much, but Robert Kiyosaki's Rich Dad Poor Dad, because even though it's not, it's not an investing book, it's not heavy at all, but I think
I think there is quite a few elements of investing in there, but not in terms of stock, just in terms of how you think about money.
But I think there are some sort of a little bit of wisdom, and it's very accessible. So even if you're a younger listener, not very experienced with any of this stuff, then you can kind of get into it a little bit. And then they're
going to be doing a review on that shortly as well, on the channel.
Oh, okay.
So
that's good.
We can summarize it for you as well.
Yeah. So there are a few easy books, and then you could graduate to more difficult ones once you understand what's there, really.
The other thing I will do, just to wrap it up, is unless you have something else you wanted to add in. You about to say something?
I don't think there's anything.
So we'll leave the link to the books. The other thing I will leave is a link to my pie.
A link to your pie.
A link to the pie. So if anyone wants to just copy the Dividend Pie and use it for themselves, you can do that.
Yeah.
And I'll leave a link to Trading 212 as well. And if you use the link, you get a free share when you sign up.
Okay. So...
Yeah? Should we leave it there?
Yeah.
Okay. Thanks for watching as always. And see you next time.